So the one big beautiful bill, and believe it or not, that is literally the official name. That is the name that's recorded. That's what we're gonna have to cite. We've been saying um, OBBB to try to make it a little more tolerable, but yeah, that's what you're gonna see in our memos now. It's not a joke. It's not slang. That's the actual name of the bill. So the the good news is, despite it being some people say over 900 pages. There's really not too much that's changed. The one big one is the exemption that we're going to get to, but a lot of tweaks here and there, a lot of little calculations here and there, but overall nothing major. So this will actually go pretty quickly today, just to give you peace of mind that um, really besides the everything is kind of status quo, which I guess is a change from it. We were going to have big changes and we're not having them. So the change is there's not going to be a change. So we should go through this relatively quickly today. As many of you know, I'm Josh Maxwell. I'm the managing partner here at Hone Maxwell, and we also have Jared Garfield, our associate in Singapore as well. So let's get started. So these slides, like we said, no attorney-client relationship, our standard disclaimer.
All right, thank you, Josh. I'll go ahead and kick us off here. So, as Josh mentioned, there are a lot of non-tax changes within the bill. A focus on immigration, ending a lot of green incentives, keeping or expanding fossil fuel incentives, changes to government insurance. So mostly with the tax changes and the changes to government insurance, there's been a lot of debate about the bill favoring wealthy at the expense of those who are relying on government insurance and other incentive programs through the U.S. So that's one of the main debates about the bill. You may have seen in the news or seen commentary on that already. One
Yeah,
of
I think
the
a lot of the stuff that you guys have heard and probably why you think this bigger than it is that it's like Jared said, it disproportionately favors the wealthy, and these changes to the government insurance are a lot of the low income people, and a lot of them are in districts that voted for Trump. So the Democrats and Republicans are really fighting about this, where at the end of the day, there's not too much there except everybody's really trying to make it sound much better than it is or much worse than it is. And especially immigration is obviously a hot button issue. Benefits for low income people is a hot button issue. So because there's a focus on these areas, it's just a very political type of law, maybe more so than it is a legal type of law.
Yeah, one of the main changes, I guess, is that a lot of the laws that were implemented in 2017, the first time around with Trump's tax changes, have been made final. So a lot of those, when they were originally implemented, they had sunset provisions, meaning that they would automatically end at some point or they were reduced over time. So the latest bill makes some of those provisions permanent, so there's no more sunset provisions, and we'll talk more in detail about that later on.
And also with
And
the no sunsets is why there's an issue with a lot of the budgeting, and you've heard a lot of arguments about the deficit because when the Tax Cuts and Jobs Act was passed in 2017, most of the big tax breaks were only for several years. So they weren't going on infinitely into the future. And so therefore you could kind of quantify, okay, this is only going to cost us X. But now that these changes are permanent, it changes the budgeting. That's why some of the government programs have had to be cut or scaled back because there's no finite amount of what this bill is going to cost.
yes, there also were some changes to international tax, so it remains an area of focus for the government. We'll talk more about the changes later on. Most of the international tax changes will affect U.S. taxpayers, but there are some others that we'll talk about as well.
And I I think that, when Tax Cuts and Jobs Act came out, GILTI and the transition tax and some of these things felt like they sort of pulled them out of thin air. We have to tax offshore earnings or we have to tax offshore intangible income. But this time they're tweaking them with such little specific tweaks that it makes me feel like they're giving this much more thought. They're actually looking at what that income is. they're actually looking at the tax effects of it. And that's why I say that I think this signifies the international tax is more on the radar because they did some things that made the calculations easier. They did some things that made the calculations have round numbers. So you can tell that people are actually putting thought into this as opposed to, some of the stuff in Guilty just made no sense and felt like it got pulled out of thin air.
Yeah, so as we mentioned earlier, mostly the changes are adjustments to existing law, adjustments to limits or calculations rather than new taxes or removal of existing taxes. So most of our advice would remain the same. The laws that we're applying remain the same, but the numbers will change a bit because the calculations have changed slightly. So there could be some situations where the effective tax rate changes, but the law being applied is the same.
Yeah, we've looked pretty extensively at this, and there's really no planning. Like he said, our memos, I think, wouldn't change at all. We would still be giving the same advice, just with a slightly different number. For lower income taxpayers, there are some things that, could be done or tweaked, but we're talking about amounts that most of our clients would be phased out of and wouldn't qualify for. And the amounts of savings would be so small that they wouldn't pay us, several $1,000s for a memo to save $500 on their tax return. So there's not really much planning or opportunities at the higher level of wealth or running a business because those little changes phase out, and then the bigger ones just didn't really happen.
Some of the main changes with business taxes are the depreciation and R&D expenses. So originally in 2017, Trump enacted these provisions for depreciation. It was called bonus depreciation, where instead of taking a deduction over the useful life of an asset, certain assets you could just take the full deduction. You can expense the full cost of the asset in the first year that it's placed in service. Similarly, for the R&D, you would, instead of spreading the costs over multiple years, it allowed you to take more costs up front so you can potentially reduce your taxable income now. And it incentivizes companies to make investments. So these were scheduled to phase out. They were one of the sunset provisions, but the latest change has made these permanent and increased the ability for of companies to take these deductions upfront rather than expensing them over multiple years.
And I think these deductions are beneficial, but most of it is going to be for small business owners or small to medium-sized businesses that are already in the US, just getting a little bump. I don't think any of these are incentive enough where outside companies are going to come to the US for manufacturing or something else or to do R&D strictly because of these benefits here. If you're already going to do that, it may be a nice add-on, but again, I don't think if you're manufacturing in mainland China, you're going to say, well, we should jump to the US. We got this depreciation and this R&D benefit. Maybe you're going to do it because of tariffs or something else, but really this is just for more the small to mid-sized businesses in the US.
Yeah. And no other major changes there. Just a few tweaks to the deductions.
Yeah, and one thing we take it for granted, but maybe you're not all well aware that the 21% corporate rate, that was always a permanent change, but there was no adjustments to that. Trump had discussed, maybe going to 15% or 10% over the years. He's suggested a lot of things, but it's still at 21%. That was never set to sunset. There was never any change. So the current law still stands that the corporate rate is 21%.
So moving on to individual taxes, most of these would impact U.S. tax residents. So we'll talk a bit more on the next slide about who it will impact. But the tax rates remain the same. So originally, in the previous Trump administration, they lowered the maximum tax rate to 37%, and they expanded the tax brackets. So you had more income taxed at the lower brackets. And that's remained the same. So this latest law has solidified that. It also expanded the standard deduction and other tax credits for individual taxpayers. The qualified small business stock, that was an existing benefit. It's for certain types of corporations where the shareholders can potentially sell the stock of the corporation and exempt a large amount of their gain from taxation. So previously, it was $10 million that could be exempted from tax. It's been increased to 15 million, and they expanded some of the eligibility to make potentially uh, more businesses qualify for it. They also shortened the holding period. So previously, the benefits would phase in at 5 years. Now it's phasing in at 3 years. So this is
Hmm.
potentially a good planning opportunity for particularly those with startup businesses. If they are U.S. taxpayers and they want to use the U.S. company, they can potentially plan for this exemption.
We're seeing a lot of this planning right now. A lot of people restructuring businesses so that their exit strategy can qualify for this plan, or potentially using different structuring and setups so that they can qualify for this. So this, $5 million increase is not nothing. That potentially saves you, a million to a million, 1.5 million additional in taxes if you're selling a business.
Yes. Some of the other changes were less for the private client type of individual, more so for the average ordinary person working a full-time job, right? So it's like the overtime and tip income. Most of our clients probably won't benefit from this. Maybe their employees might benefit from it, but essentially what it did is exempted some overtime income and some tip income from income tax. So the benefit, I think, is a bit less than what most people were expecting when they heard overtime and tip income was going to be tax free. But still, it probably will benefit quite a few people who may be on tighter budgets. They may notice the increase and be happy about that.
I think this is where the debate, between who it favors comes up, because also the other changes, the standard deduction that phases out, the state tax deduction has a low limit, the child tax credit phases out. So it's benefiting, like he said, most of more of like the blue collar, lower to middle income type workers. So, they hear that the overtime and the tip income is going to be exempt, and that's huge for them. That's not nothing, but you think about somebody, let's say they're working at a restaurant, maybe making 20, $30,000 a year, and the tip income doesn't have to pay tax on it. Well, that's fantastic to them, but then look right above it, and the person selling their business for 15 million gets $5 million exempted. The people getting the benefits here, in 10 lifetimes aren't going to get the tax savings that that person above it is going to get, on one sale. Or the tax rate, the maximum tax rate from, excuse me, 37% remaining there as opposed to when it used to be 39.6. I mean, you can see pretty easily that the high earners are getting huge savings compared to the other ones. But a lot of these people, they don't look into the details. They just see their overtime or their tip income is lower, their standard deduction is higher, and their tax return is going to look better, and they kind of don't care about the rest. Not passing judgment whether that's good or bad, but that's where kind of the people are butting heads on a lot of this.
Yeah, so as we mentioned, most of these changes will be for US persons. So if you're working primarily with non-US clients, a lot of these changes may not impact them. So we just wanted to go over who it would impact. For the income tax changes, it would impact any US citizens, green card holders, or those who are meeting the substantial presence test by staying in the US long term. Um, for the transfer tax, that would be the estate tax and gift tax. It affects U.S. citizens and U.S. domiciliaries. So the main difference would be green card holders are always a bit of a gray area between these two. But primarily, it affects U.S. citizens and those who are living in the U.S.
One thing I should have mentioned, I apologize at the beginning, is if you have questions, feel free to use the Q&A or the chat function. I'll occasionally monitor that in case you have any questions you want to go over. But back to this, the reason we put this slide here is because the next thing is really the crown jewel of this whole tax plan, the biggest change, which is a no change. But if you only remember one thing from our presentation this morning, if you just remember this detail, you can probably forget everything else and it won't really matter.
Yeah, so previously, if you had attended our other presentations or following on our blog, you may have seen that the estate and gift tax lifetime exemption was planned to be reduced to around $7 million next year. So currently it's 13.99 million. Next year, it was scheduled to be reduced to around 7 million, but this latest law changed it to 15 million next year, and it made the change permanent, so we don't have any planned sunset for this law anymore. And it'll be continue to be adjusted for inflation each year. So this is for U.S. persons who are planning for their estate and gift tax. The exemption allows them to essentially pass $15 million of wealth onto whoever they want through gifts or through their inheritance without having any gift tax or estate tax. The main thing to note is that the exemption for non-U.S. persons has not changed. It's still $60,000 only. So it's still very low, still hasn't changed. There's not really been a lot of political discussion about it. I think it's just off everyone's mind. So the main thing has been with for the US persons with their exemption amount.
Yeah, I think many people still don't know about the only $60,000 exemption. I mean, I've been dealing with people today that are, still buying in the US and haven't heard of that. So like Jared said, I don't know if it was a conscious decision to not change it or it's just not on their radar. But this is a great kind of example of how I said our memos won't change, just the numbers a little bit, because we've been giving advice based on a $14 million exemption and telling people possibly going to 7 million. So just a $1 million increase is not going to make a huge change in the type of planning we do. And also keep in mind if it's US citizens who are married or US domiciliaries that are married, that's 15 million per person, so $30 million per family. So have a lot of leeway there. And also, as we always discuss in our presentations, depending on your global wealth, it may be better to be a US person. So if you have 5 million or 10 million in the US, but your global wealth is 15 million or less, you'd want to be a US person because then you wouldn't have only the $60,000 exemption on the high US amount, you'd get the full 15 million. And even though that then applies to your worldwide assets, you're below the exemption amount. So, but again, nothing new. But I think this is the biggest takeaway from the bill is that we don't all have to run to do planning to take advantage of that extra amount before this sunsetted to 7 million at the beginning of next year.
Yeah, so now we'll talk more about the international provisions. Most of the changes have related to our controlled foreign corporation or our CFC rules. So these are, we won't get into too much of the details on definitions, but essentially US controlled foreign corporations. This is what would apply. So previously we had two regimes. One is called GILTI, one is FDII or FDII. Uh, GILTI was sort of, or sorry, FDII was essentially the incentive to keep profits in the US, and then GILTI was sort of the disincentive to move profits outside of the US. So FDII encouraged FDII encouraged inbound investment, and GILTI discouraged outbound investment. So there have been some changes to the calculation, and they've been renamed. So GILTI's been renamed to net CFC tested income, and some of the calculation has changed. FDII has also been renamed. The calculations, although they've changed, it sort of makes a bit more sense now. So previously, it appeared that these were taxes targeting intangible income, but then the calculations really didn't work out that way. The calculation had no mention of intangible income. It really affected any income outside of a 10% return on fixed assets. Everything else was caught up in it. So the name made it appear as if it was targeting intangible income when really it was targeting all types of income. Now it's been renamed and the calculation's been simplified a bit. So it seems like they're sort of uh, getting this, getting the details worked out, getting it more streamlined to make it easier to follow for taxpayers.
And that's one of the things I was talking about at the beginning of the 10% return on fixed assets. Where do you pull that out of thin air? I mean, if you're a services company, you don't have any fixed assets. What if you have a very valuable asset that you generated more than 10% return on? And so the fact that they had that before felt like, oh, we need to go after this type of income, but we don't really know what we're dealing with. So now that they eliminated that, made the calculation a little more simple, made it a little more over-encompassing or all-encompassing, I think that it signifies that they are really going after those goals of incentivizing money to come in and disincentivizing money to go out and kind of just making it, very straightforward. Guilty is difficult to deal with. You really need to look at the planning of it, especially places like Hong Kong and Singapore, where the rate is going to be low on the local foreign-owned company by an American. It's probably going to apply. So there's, some planning to be done there. The FDII or the new FDDEI, I don't really know again why they make change the names to make them more complicated, but I think that's a good incentive to come into the US and to just kind of give you a high level example of how that works. We have a client, so a real life example, a client that buys machinery from Asia and he sells it to businesses in Mexico. So he has nothing to do with the US and no reason to have any ties to the US. So if he sets up his home office or his, main parent office in the US and that office buys from Asia and sells to Mexico, he would benefit from the old FDII and the new FDDEI because basically the way the law works is to say you have no reason to be earning that income in the US. Therefore, we're going to give you a tax break to bring it there. And that can be very favorable to some people because we also have very strong, copyright trademark laws here. So it's a good place. We have a strong rule of law in case someone is going to have a lawsuit. So it's a great incentive, and we already have a very competitive corporate rate. So this bringing it down to effectively about a 14% rate, if your full amount qualifies, is definitely a good incentive. So both of them are things to plan for, guilty to make sure you don't cause issues, and FDII to see if you can take advantage of it. And for like guilty, we had a client that set up in Vietnam and negotiated a tax holiday. And they spent a lot of time and effort negotiating it. The local government wasn't happy. And then in the end, all of their income in the Vietnam business was taxable in the US anyways under guilty. So had they come to us first for planning, we could have told them, go into Vietnam, pay full taxes, don't waste time negotiating, a tax holiday, look like a hero to the local government to be paying full taxes because you'll get a credit on that guilty that you have to pay tax on in the US anyways. So I don't know if that's a planning to make things better, but it's a planning to take advantage of a tax you're already going to have to pay. So again, I think the takeaway from these is that everything you knew about them that we've always talked about is still there, but because they've made some of these little tweaks, it signals to me that this is on their radar, that they are looking at this and they want to start enforcing these more.
Some other notable provisions. So the 954C6 look through was permanently extended. Um,
Sorry about that.
sorry.
I was checking our Q&A and clicked too far.
That's all right. So that's another CFC provision. If you're not familiar with it, we won't go into too much detail, but this was already in effect. It's just been extended permanently, so there's no more uncertainty about it going away. The downward attribution also relates to CFCs. So this was
I mean, I can
the
jump in here and summarize it that we don't need
yeah.
to. This is the most complicated thing that I think that we do. This is besides maybe FERPTA, this is one of the ones that I still can't say off the top of my head what the rules are because it's about downward attribution and it creates some very odd scenarios of an American owning a foreign business and then potentially looking at who else owns that business. And so you, instead of just saying American to foreign business, you're looking at the up and down. So you have to maybe know people that are not a part of it or include businesses that you may not consider. So it's making our CFC rules a little more complicated. And it was difficult to do some of these to look at who's a CFC. It wasn't as straightforward. And again, CFC is a term of art. If you don't know, it's controlled foreign corporation. But those are the entities owned by Americans that cause the GILTI or the new tax that we were just talking about. So they did simplify it, but then they left in just a few provisions, kind of anti-abuse provisions. So going through them, I think we're going to need some real life examples to see who those are actually catching up. But to me, what it looks like is they're looking at people who are trying to circumvent the CFC rules by using downward attribution to control businesses that it didn't look like they controlled directly. So it is simplified, but I don't think it's a planning opportunity because they did keep a few basic rules in there to kind of go against the anti-abuse provisions of it. But as far as it goes, it's always going to have to be, we're going to have to do the analysis. Even sitting in a meeting, getting the facts from the client, I still have to go through the rules because it's very detailed about when you consider it, when you don't.
Yeah, the other change is with Subpart F and guilty applying even if you don't own stock of the company on the last day of the year or the last day was a CFC. So essentially what that does is it makes it important uh, to pay attention to Subpart F and guilty for restructuring, even if there's just a temporary structure in place or just one step of the process, a CFC is formed uh, or owned at any point, you now have to look and even if you don't own the stock on the last day of the year, it's just part of a restructuring process. You still have to apply the guilty in Subpart F.
And
Uh,
this is definitely taxpayer unfriendly, but I hate to admit it, it makes perfect sense to me because we've run into scenarios where somebody was going to have a lot of guilty or a lot of subpart F, and then they sold the business in the middle of December to somebody else, and they just wash their hands of it. That's the end of it. So uh, I guess it takes away the planning if that's why you're doing it. I don't know necessarily if you would sell your business just to get out of subpart F and guilty. I don't think that that would be the sole incentive to do it. But it was definitely a nice perk to people who were getting out of a business. So they no longer can do that, which makes sense that if you own the business and you have guilty just because you sell it, why would that erase the fact that you did hold it while it was accumulating guilty?
yeah. And then for the remittance tax, this is one of the provisions that in the House version of the bill, it was much stronger, it was much more impactful, and then they sort of backed it down to pretty uh, pretty much nothing. So originally, it was proposed as a 5% remittance tax with very limited exceptions. The only exception they had in there was if you're a U.S. citizen. So this would have applied to anyone who's not a U.S. citizen who's sending money from the U.S. to another country. It wasn't clear how it would apply if you were sending money to yourself in in one of your foreign bank accounts. But now it's been reduced quite a lot. It's been reduced to 1%, and it's very limited in scope. It's only applying to cash or cash equivalent remittances. So if you're using cash or a money order or a cashier's check, something like that to remit money, then it would apply. But bank transfers are exempt. So if you're just sending money between bank accounts, you don't have to worry about this, although it looked like you would have under the original version of the bill. So I think this is a much better for taxpayers. I know we had a lot of clients worried about this, and people were asking me about it. So I'm glad to see that this has been dialed back quite a lot. The other one, oh sorry, Josh, you can
Yeah, I
go
was gonna
ahead.
say on this one, we try to stay apolitical looking through this, and overall, I think a lot of these tax changes are good. This one sits with me the wrong way. I'm not, embarrassed to tell you that because who does cash transfers? Who does those type of transfers? It's not, our ultra high net worth clients. They're not going into a grocery store with $3 million in cash and saying to wire it to, their cousin at a convenience store in another country. And the amounts that these people are sending, originally the provision sounded like, well, we don't want cash leaving the US system. We want to keep it here. So how much are these people who are doing these cash transactions really taking out of the country? And to me, it just kind of feels like a slap in the face to the workers who are likely to be undocumented coming here. And so this one, it looks like a disincentive for illegal immigration to come here and work because a lot of them come here, they work, they get paid in cash, they send the cash back home to their families. So it's not really revenue generating. They're not going to be sending enough that that 1% makes a difference. But now it just makes it more difficult for them, and it makes it feel to me like more of an immigration disincentive than anything to do with taxes, and kind of feels like a slap in the face. A guy making a couple $100, let's say a week, and he needs to send money back, so his mom can pay her bills in a foreign country. He's going to get hit with a tax, but somebody wiring millions out of the country to move it around has no problem. That this one feels political to me and feels more geared towards immigration. And I can even tell you on a personal level, we have family in another country. My wife is not from the US and we send them money. And my wife goes to the grocery store and, takes some cash and we send it to them and they get it at a convenience store in their home country. And now I'm concerned because, citizens are exempt. So does that mean now my wife has to present her passport? And does that mean that's now going into a system that the convenience store in that foreign country is going to get? And they're going to have all my wife's personal info and the fact that she has enough money to send back to family. So I don't really see any incentive for this other than because it's going to cause a lot of problems other than to kind of disincentivize people to come here and work and send money back home. So not to get political, but it's hard to look at that and come to any other conclusion.
Yeah, we had a question from Chris about who will enforce the remittance tax. So it's being enforced by any remittance provider. So as Josh mentioned, in the US, you could go to a grocery store, give them cash, they can send the money to a convenience store in another country. That would be an example of a remittance provider, and they would be the responsible party for this tax, so they would have to withhold it and pay it to the government. Otherwise, they risk penalties of their own. So it's really just if you're using a remittance provider, sending through cash or cash equivalents, like a money order or cashier's check, then that's when it would apply.
Yeah, again, and I think there was a lot of and a lot of the commentary, a lot of the problems with overall with the bill is going to be the kind of the enforcement of a lot of these things, a lot of these little like details of who's going to look into these. And if you look at like the tax foundation, who normally tries to do kind of a non-political overview of new laws, a lot of the frustration is that these rules, just like the one here with the downward attribution, things keep getting more and more complicated. And who's going to enforce that? I mean, the IRS is supposed to be getting more people, but is going to be difficult with enforcement on a lot of these things. So that's going to remain to be seen as how all of that part of it is going to shake out.
Yeah. And then the other one I wanted to mention that you may have heard about, it was called the revenge tax or Section 899. It was originally planned to be a way for the president to increase taxes on other countries who are earning US or other individuals in countries that had tax provisions that the US found to be discriminatory. So originally that would have been targeting countries with digital services taxes or other similar taxes. So that actually was not enacted. So I think that's worth mentioning. It was an interesting provision. A lot of people were surprised by it, and it never went through. So I guess we'll see if that ever gets proposed again in the future.
Yeah. So that wraps it up unless you have any questions. But again, I think that hopefully you may have come here to learn something, but hopefully even better, you found out you didn't need to learn something, that you could kind of go status quo with how you were before. If you were advising clients on a $14 million exemption, it's now 15. That's not that big of a change. So there's really not a lot here that's going to change what we do, except some simpler calculations and also that we don't have to worry about this change coming up in 2026. But again, I think with everything we've seen with the IRS, international tax is a high priority, and I think that they're going to continue to look for that and look for enforcing that into the future. So it's a good time to try to get everything in compliance, get everything cleaned up as these changes are made, so you can start fresh if there's any issues there. But as we go through this, we will continue to blog on the new changes. We'll continue to blog on as we run into client examples. But, as always, feel free to reach out to us if you have any questions. If send us an email or WhatsApp or anything, we're very responsive. Jared's in your time zone, obviously in our Singapore office, so he can get back to you, same day. But we just want to keep the information out there because since this is so political and since people are arguing about it so much, I anticipate a lot of misinformation. I anticipate people thinking that this is a lot worse than it really is. So we just want to let everybody know, kind of status quo on our end. Let's ignore the noise and keep working together to move forward.
Yeah,
So I
thank you,
we had
everyone. I
one
think
more. Do you thinking?
yeah, we had one more question about Section 899. The question is, do you think it's done and out for Trump's term? It's hard to say. I think that this was probably going to be the most comprehensive tax changes for Trump's term. I think they were trying to squeeze everything into this one bill. So I wouldn't expect it to come back, but you never know. I think if we are getting more tax changes in the future, it might be more related to cryptocurrency. I heard that that was in the works, but I haven't heard about Section 899 coming back.
Yeah, I think with everything else going on, that it's unlikely we see any more tax changes in the next 3 years, especially since, in these times it's hard to prognosticate, but most likely next year, just the way our politics works, when one president wins, they usually lose Congress the following 2 years. So it's unlikely a little over a year from now that he's going to have the people he would need to make changes, especially since, this one barely passed. And so it seems very unlikely. And now, he's moving on to other things. I think he's checked the box on the tax changes he wanted to make. I think we're unlikely to see more, but stay tuned because the way things are now, if 4 years we get the Democrats in there, this may all swing back. But I think at least for the next 3 years, we can take a breath and just keep moving on the way we are. All right. If there's nothing else, thank you all for joining. And this is something I was just recently in Singapore and in Hong Kong earlier this year making these presentations, but we're going to try to do these update calls maybe every quarter just for 15 to 30 minutes to give some updates on what's going on or to answer any questions you have. So as you progress, if there's something you'd like us to talk about, please feel free to send me an email. And if we get enough interest, we can do a quick webinar on it. And also, Jared and I do our presentation a few times a year in Singapore. We can start building material for the next one there if you have questions. But, happy to just keep getting the information out there to everybody and keep working with you. So thanks again for the support and thank you everybody for attending. Anything else, Jared? Are we good?
I think that's all for me. Thank you all again for joining.
Okay. Thanks, everybody. We're signing off now and we'll talk to you soon. Have a good day.